modified endowment contract for life insurance just means it's got too much money in it. It came about because we got pretty abusive with these in the 70s and 80s. Single premium life insurance rates were high. You could stuff a boatload of cash into a single premium life insurance policy. They would fund the cost of insurance in the spread between what they were paying and what they were earning, but interest rates were so high that you could still take more income out of these than like a municipal bond would pay, and it would be tax free because it was return of principal. And it was abusive. I mean, there was so much money going into those things because of that. So that's why it got squashed. And these rules came in as the 7-pay rule. So what it does is understand this first, that being a MEC means it's failed the 7-pay test, which they lay out based on the age and the face amount of the insurance, how much can be stuffed in there, basically year by year over the first 7 years. And if it's violated, then the MEC loses its living distribution tax advantages. And they start looking like annuities from a taxation standpoint. A MEC, here's a good exam question. A MEC does not change the tax treatment of the death benefit. So they actually still can be a good idea for someone who has a sizable life insurance need, just wants to one-time fund it, and all they're after is the death benefit. It could still make sense. What got crushed was, well, I'm going to use it like a muni bond or better, and I want to take income out of it every year. But it's still, the life insurance death benefit is still tax-free, MEC or not MEC. So don't be fooled by that question. So they're testing the amount of premium, and the focus here should be on the 7-pay tests. Technically, if a material change is made to the contract, like the face amount reduced, that would trigger another 7-pay, but I don't think that's going to be the case on the exam. It's just, do you know what the 7-pay test is? And most likely the exam's just going to tell you it's a MEC, and you got to know what that means. And it's going to be all about distributions in the form of withdrawals from a universal life policy or loans from a whole life insurance policy. That's what changes when it has MEC status. And my bet is that it's going to tell you that, and you're going to need to move on. So what it flips is that life insurance enjoys, on a non-MEC policy, it enjoys the tax benefit of when you do take a living distribution. It's considered FIFO. It's basis first, it's principal first. So you can make those withdrawals tax-free. But if it becomes MEC, then it flips and it's more like an annuity, and it's considered LIFO. The earnings are coming out fast first, and then you would get into the premiums that have been paid, the return of the basis. Now, the ceiling on this, and you've got a practice question in just the 3 for this highlight, testing this. The ceiling for how much of it's taxable is the gain position they're in. So if they're in a $20,000 gain position and distribute $30,000, 20,000 of it is LIFO and going to be taxed and possibly penalized because that 10% early withdrawal penalty comes into play. The other 10 is a return of premium. So understand that when they give you what the value of the contract is and how much premium they've paid in, there you can set, okay, they're in a $50,000 gain position, $100,000 gain position. Then we look to how much are they actually taking out as a living distribution, remember, not death benefit, as a loan or a withdrawal. Loans in a non-MEC policy come out tax-free, but not in a MEC policy. They get switched to that LIFO treatment, but you've got to identify how much gain they have. Maybe that would be given in the test question, and they just give you how much they took out, and you got to know how much of that is taxable. But the gain position sets the ceiling on that LIFO treatment. And then don't forget, if they're not 59.5, don't forget, they could be looking at another 10% on top of the marginal tax bracket that you're giving. If they're going to make you calculate the tax, they're going to give you the bracket. And then you need to know to tack 10% more on that if they're not 59 and a half, which they won't be in that question, right? They're going to be younger than 59 and a half. And so there's going to be marginal plus 10%. And again, these, with a little practice, you're like, okay, I hope I get more than one MEC because I can sort these out and get them right. You're not gonna, it's not going to be tested on the theory or the definition of 7 pages. No, that's the premium limit over those first 7 years. They're not going to get into the fact that it's cumulative. And if they don't max it out in year 1 of the 7 pay, they can add that to the second year. They're not going to get into that. So don't worry about it. Just focus here on what it changes for living distributions. And we're going to flip it to LIFO based from FIFO based. Know your parameters in the math. And you're good to go on these. I haven't had anybody mention in the last couple of years that they had, 3 of these or so, but that has happened in the past. I honestly think you might get 1, but I'm not picking the questions, but I just know that they've been out there.